Hello class, and welcome to the video lecture for recording transactions for dividends, treasury stock, and retained earnings. The second learning unit covers journalizing dividends. In the last chapter, you learned how to calculate dividends. In this chapter, the amount of the dividend will be given to you, and you will need to journalize. First, there's 3 important dates you need to learn in order to accurately record dividend transactions. The first is called the date of declaration. The date of declaration is the date the Board of Directors announces its decision to pay a dividend. On this date, a liability is incurred to pay the dividends. The date of record is the date on which it's determined which stockholders will receive dividends. This is a matter of pulling a list of stockholders from the company's records. No financial transaction happens on this date. The date of payment is the date that the dividend is paid to the stockholders. Let's go over the example in the textbook on page 685. On March 8th, the Board of Directors declared a $2 cash dividend per share. March 25th is the date of record, and April 16th is the date the dividends will be paid. Here's the journal entries. On the date of declaration, a liability is incurred. A dividend liability is recorded as a credit to the dividends payable account. Dividends are paid out of the retained earnings of the company, so retained earnings is reduced with a debit. The next date was the date of record. Remember that there's no journal entry on that date. It's the date the company pulls a list of names and other pertinent information of stockholders. The last date is the payment date. On the payment date, the previous liability is reduced with a debit to dividends payable, and cash is reduced with a credit to cash. Now let's look at a different kind of dividend. A company doesn't have to pay dividends in cash. It can pay in the form of more stock. This is known as a stock dividend. On the date of declaration, retained earnings is reduced with a debit to retained earnings, just like with a cash dividend. However, we don't have a credit to dividends payable. The dividends payable account refers to the payment of cash, but in this case we're paying more stock. By paying more stock, we're increasing stockholders' equity. In this case, we credit a stockholders' equity account called Stock Dividends Distributable. If we distribute a value from retained earnings that's more than the par value of the stock, we might also need to credit a paid-in capital in excess of par value account. Let's look at the example in the textbook on page 687. On December 27th, Ch19 Corporation declared a 10% stock dividend distributable on January 27th to stockholders of record on January 13th. The stockholders' equity of Ch19 Corporation before the dividend was declared is shown here. We have common stock, $20 par value, 15,000 shares authorized, 10,000 shares issued and outstanding, for a total par value of $200,000. We also have paid-in capital in excess of par for $24,000, retained earnings is $62,000, and total stockholders' equity is $286,000. The current fair market value of the stock is $30 per share. Let's journalize the transaction on the date of declaration. First, we have to determine the amount to take from retained earnings. The amount is the market value of the shares times the number of shares issued times the percent of the stock dividend. So if we have 10,000 shares outstanding, 10% of that is 1,000. Remember the difference between authorized shares and outstanding shares. Authorized shares are the number of shares that the company charter says it can issue. Outstanding shares are the actual shares purchased by stockholders. We're giving a dividend to stockholders, so we use the quantity of shares in the stockholders' possession to calculate the quantity of shares to be distributed as a dividend. So we're going to distribute 1,000 shares, and each share has a market value of $30. So that's $30,000. We reduce retained earnings for this amount with a debit. Now we record the increase in stockholders' equity. We record a credit to common stock dividend distributable for the number of shares to be distributed, which is 1,000, multiplied by the par value per share, which was $20. This works out to be a credit of $20,000. The rest is a premium recorded with a credit to paid-in capital in excess of par, which is $10,000. Now let's move on to the date of payment. On the date of payment, we reduce the previous credit to common stock dividend distributable with a debit. This will zero out the distributable account. We replace it with a credit to the common stock account itself and issue the stocks to the stockholders. The last section of Learning Unit 2 mentions stock split. A stock split is when additional stock is issued to stockholders, but it's not a dividend, and there's no journal entry. What happens is the par value is reduced, and the number of shares authorized, issued, and outstanding increase. That wraps up Learning Unit 2. In the next Learning Unit, we'll go over accounting for treasury stock.